Hey, good morning, everybody. Hope you're all doing very well on this Saturday. So, first weekend without football for a while, and you got to admit, I'm not happy about either of the two teams remaining for the Super Bowl. So, having grown up in Michigan, uh, I'm not used to seeing the Lions advance as far as they did, but I am used to seeing them kind of choke, and that's exactly what they did. So maybe next year. That's been the motto forever. Anyway, so today I'm just going to talk a little bit about the Magnificent Seven. Those are the kind of the hot seven stocks that are really, they are the market right now. And we'll talk a little bit about that. And I was going to really dig in deep and try to do some cash flow analysis kind of stuff and show you. But tax season's kicked off here. It kind of kept me a little bit busier than I thought I'd be. So didn't get too much into the weeds, just sort of general overview of it. But, I'm sure most of you have remembered the, 1999 tech bubble. And it just feels the same way. Instead of it just being strictly technology, it's now getting condensed down into seven stocks, seven companies that are doing it. And, these companies are kind of, they're great companies. They're fantastic companies. And they are, for the most part, delving into the whole AI thing. But, while AI is going to be phenomenal, it's going to be a factor in the world going forward without any question. Just the way we do computing is going to be different. But so was the internet was too. So the internet in 2000, it was absolutely revolutionary. Think about that, how it changed your life in such a short period of time and how you couldn't imagine living without it right now. But the thing is, you get to a certain point where, despite the fact that there's an abundant future for the technology and the stocks that provide that technology, you still have to remember there's investing in speculation, that you're still an investor. And the goal of investing, as Warren Buffett always says, is you basically want to look at what kind of cash flow are you going to get and what's the price you're paying for that cash flow. That's what you're looking for. And despite the fact that you have companies that are in an upcoming technology and, it's going to be around forever, you still have to look at, what are you paying for this? Every time you purchase an investment, there's a saying in real estate: you don't make your money when you sell your real estate, you make it when you buy it. So if you buy your real estate at a high price, a price that doesn't match what you could get for rents or something like that, you're going to lose money. You're absolutely going to lose money. So the purchase price is always the critical factor. So let's jump in a little bit here just to talk a little bit about the Magnificent Seven is what they're being called, and some perspective. So the seven stocks that make up the Magnificent Seven, and we're talking Apple, Amazon, Tesla, NVIDIA, Google, Facebook, and did I say Microsoft. Those are the seven stocks that we're talking about here. Let me shut this camera off. So those are the stocks we're looking at, and kind of give it some big picture perspective. Right now, those seven stocks alone are bigger than the stock markets of Britain, Canada, or not Britain. Yeah, there's another country. Britain and UK are the same things. There's another, I can't remember which one it is, but three defining countries, bigger than their stock markets combined. It's starting to get pretty crazy. The value of those seven stocks alone is larger than every country's gross domestic product, with the exception of US and China. So it's, bigger than very large countries like India. Japan has a very large GDP. I mean, those stocks are bigger than that. And right now, the thing is, it's making up 50% of the value of the NASDAQ, or what tech stocks are. So 7 stocks making up 50% of the whole NASDAQ. And if you take just 2 of those stocks, Microsoft and Apple, their value is more than the entire Japanese stock market right now. I mean, it's just absolutely insane. And again, they're phenomenal companies. They are great companies. It's just, what are you looking at? What are you paying when you purchase stocks in these companies right now? So this is just a chart I saw in the end of December showing the 2023 performance. 2024 is already kind of really heading upwards for some of these companies. Meta, which is also Facebook. Meta's having a great year so far. Nvidia's having a great year. Amazon, Google having really good years. Now, Apple and Tesla are down, but for the most part, these stocks are still kind of continuing, and it's getting pretty crazy. And if you look at it, going back here in the beginning of 2022, I mean, really, it is the return of the S&P 500. So the S&P 500, for the most parts, it's up a little bit. But if you take out the Magnificent Seven, I mean, it's up, but it's not really anything to write home about. But the Magnificent Seven has just been absolutely crazy. I mean, those 7 stocks are the market. So most of the gains that the market has had is because of those 7 stocks. And if you look at the market capitalization of the S&P 500, so you take the value of all of the S&P 500, it's about $40 trillion. And if you break it down, the Magnificent Seven is about 12 trillion of that 28 trillion. And I mean, that's just unbelievable. The other 493, they were at 28 trillion. So you're starting to get the point where you just really don't have a real market. And it's bubble is probably a kind word to say about it. This is kind of comparing the Magnificent Seven to a lot of different indexes here. And so it's a busy chart, but you can kind of get the point that most stock markets, most sectors are basically flat at best, and the Mag 7's just been up, going crazy up. So some of the other sectors this thing is looking at is XLE is the oil ETF. So that's the oil component or energy component of the S&P 500. RSP, the little blue line, that is the S&P 500, but it's an equal weighted S&P 500. So you take all 500 companies and they all have the same value. It's not a market cap weighting, it's an equal value. So all 7 stocks have the same proportion in the fund as the other 493. So that hasn't done much. IWM is small company stocks. So usually if the economy is really booming, it's the small company that are doing so much better, because you get better growth rates in small companies. When you're a small company, you can grow a lot faster than if you're a $1 trillion company. It's just size, it's the dynamics. So usually if you see the economy is really going, small cap stocks are sort of leading the way. And then the last 3 that they've got there are essentially international stuff. So you're looking at broad-based, diversified international, and then the last one, FXI, that's China. So you can see China is actually really getting hammered. It's the red. It's going down. It's been getting their stock market's been getting pounded lately. And in fact, it's back to levels, I think, 2005, I want to say. So you can see it's really just unfathomable what's been going on there. And then even if you get into the S&P 500 itself and break it down by sector, you can kind of see what's going on. You've got the tech sector, which is again basically going to be the Mag 7. But you compare tech to every other sector in the S&P 500. So, we're talking industrials, consumer discretionary, utilities, financials, consumer staples, healthcare, information technology. So that's a little bit different, but energy, materials, real estate, and then communication services. So it's just really getting to the point where we're starting to see a tech bubble, but it's really concentrated in the 7 stocks. And this is a really busy chart here, but this is looking at breadth of the market. And all breadth means is how many of the stocks are really carrying the weight. So, what you obviously want is to have a stock market where a lot of companies are hitting all-time highs and are having substantial growth rates. That's healthy. If the market's going up and you have a lot of companies participating, that typically is a good sign. If you get to the point where you have fewer and fewer companies that are actually carrying the market and are, experiencing the kind of growth that you want in a healthy market, that's a little dangerous. So the top one is just basically simple bull markets and bear markets, going back to the 60s. So you can just kind of see ups and downs. But the bottom chart is the one that shows the breadth. How much was the market being carried by a select few stocks? And you can see back in the 70s, they called it the Nifty 50. Like you had to be invested in these 50 stocks. They were the market. But then the Nifty 50 just got, derailed once the oil crisis really settled in. And you lost your shirt if you were in the Nifty 50 at that point. If you move over, you get to the tech bubble in the 90s and early 2000. You can again see the tech companies were just the breadth, the amount of the market gains due to those stocks was just massive. And if you go back, so interesting, right after the tech bubble, the percentage of the companies that were sort of performing very well. So early 2000s, you actually had a pretty healthy market. The market was going up from 03 to 07, and you had a lot of leaders there. You had a lot of companies that were rebounding. Even in the late 70s, after the Nifty 50, you can see you had a little bit more of a market where a lot of companies were participating, although that was a rough market. And then today, you look at it, it's those 7 stocks. Those 7 stocks are leading everything. So I've never seen it this concentrated before. I thought in 2000 when the tech, basically it was just internet stocks. So any companies that were internet based were doing well. But you had other sectors that were really, really cheap, compared to what was going on in the tech market. And this just kind of shows you again, are we looking at some sort of bubble here? So we have technology relative to the rest of the S&P 500. And you can kind of see we're at a level almost the peak of the year 2000. So the peak of the internet bubble. And like I mentioned, this isn't like all technology leading that way. There is a lot of cheap technology, but it's the 7 stocks that are basically driving the technology sector so far up in price relative to everything else. And to put it in perspective, so technologies, we show your technology relative to the S&P is at an all-time high. Whereas you take probably the most boring of the sectors in the S&P 500, utilities, and it is back to the level we saw in early 2000, late 99, early 2000, relative to the markets. So, or this is relative to, the S&P 500. So you could say, well, utilities are boring, right? They're great cash flow, but they're not sexy. You're not going to talk about owning Duke Energy at a party. whereas owning NVIDIA is certainly chatter. But yeah, you just get to a certain point. You could see after that 99, 2000 low, utilities did pretty well for the next few years, relative to the rest of the market, just because they were so cheap. So the boring stuff could be poised to do pretty well. Now, this is a projection of what the compound annual growth rate is supposed to be for all of these 7 companies. And they're great. I mean, it's a very good growth. I would bet everything I own Tesla is not going to grow their earnings per share 33% year over year. They haven't done it. The thing is, they make these projections for these companies, but it often doesn't end up being like this. So my point in showing this is they're obviously growing companies. They're obviously very good companies. They're all great companies. It's just you're starting to get to the point where you're paying such ludicrous amounts for it. So I'm going to look at just a couple. I was going to break down all of these, but again, kind of got a little bit busy. But the 2 that I think are the most important is NVIDIA, which has just been nutty, and then Apple. And Apple, again, a phenomenal company, but it's not the company it once was. So NVIDIA, they're talking the previous thing, saying, all right, we're going to see NVIDIA have 19% year over year compound earnings per share growth. Well, the thing is, if you look just recently, this is their revenue and earnings. And the revenue's certainly spiked up. It's kind of flatlined the past couple of years. And this is just a short term going back to 2020, but their earnings really aren't growing at 20% annualized. And they really never have. That's the thing. You dig in a little bit deeper. This is a chart. It's a little busy. I know it's hard to see. If you look at, it's got the stock price at the top. It's got the trailing 12 months net earnings per share. And then at the bottom, it has the price to earnings. So because they started, back in 2009 with this, the earnings were just fabulous. You can see from the start where the chart goes to 2009, 2010, and it doesn't look like it's growing that fast. But if you get to that peak in 2020, that was seeing easily 20% compound annual growth year over year. Now, since COVID, I know COVID's been sort of a crazy period for people, but you really haven't seen a 20% compound growth rate. But you have seen its price to earnings ratio go up substantially. And again, price to earnings is you literally take the price of the stock, you divide it by the earnings, and that's what you get. So, you go back, it's always been highly valued as far as price to earnings, and that's fine. It's good companies should have an elevated price to earnings relative to the rest of the market. And you can see here, going back again to 2010, 2009, it was looking at earnings or price to earnings share close to 25 to 30 for most of this time. And then it started to really spike up after COVID. So the earnings weren't really keeping pace with what the stock price was doing. So you got the point where the price to earnings was getting over 50, which, for a small company stock, you may be able to justify it if you're getting 20% annual growth rate. It's possible to do that. But, when you get to be a company that's got $1 trillion market cap, it gets to be a little bit more difficult. When you're a behemoth already, you're not going to be able to sustain that kind of growth. And your stock price shouldn't be priced that way. So the point where right now you're looking at over 100 price to earnings. And just to give you an example again, in general, the way you can look at price to earnings is it's the price you're paying today, and then you divide it by the earnings. So it's like it gives you how many years would it take you of earnings that you're going to get per share to make up for the price you're paying. So in theory right now, and it's assuming, say the growth stays, their earnings stay exactly the same, it would take you 100 years to get your initial investment. Now, if it's growing 20% per year, obviously that changes the picture quite a bit, but yet it still doesn't change it to the point where, 100 P/E is justified. Even if earnings are growing at 20%, this is where I was going to start to really dig into the numbers and try to show you, but it's still going to take you at 20% growth. It's still going to take you decades to get your original investment back. And that's assuming it's going to get a growth rate. So the bigger the company gets, the harder it is to grow at 20% per year. It's just very difficult. That's why you don't see many companies that can do it, but you do see some small company stocks that can do that. And what really gets me on NVIDIA is its price to sales. Right now, the price to sales is at 40. And you go back, again, going to 2009, you'd see price to sales below 10 for the most part, for most of this chart, and then started to go up. And now you're paying 40 times price to sales. That's absolutely crazy. That's not even earnings. That's just the sales that they make. And I always go back to Sun Microsystems. Scott McNealy was the CEO of Sun during the internet bubble. And Sun was basically building the networks on which the internet was running. So it was very integral to the whole internet. But after the bubble burst and everything like that, the dust had settled, he got quoted saying, they had reached a point where they were 10 times revenues or 10 times sales, not 40 like NVIDIA. So he was saying at 10 times revenues, to give you a 10-year payback, I have to pay you 100% of the revenues for 10 straight years in dividends. That assumes I can get it by my shareholders. It assumes I have zero cost of goods sold, which is very hard for a computer company. That assumes zero expenses, which is really hard with 39,000 employees. And that assumes I pay no taxes, which is very hard. And that assumes you pay no taxes on your dividend, which is kind of illegal. That also assumes zero research and development for the next 10 years. And by doing that, I can maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at $64? Do you realize how ridiculous those basic assumptions are? You don't need any transparency. You don't need any footnotes. What were you thinking? So, the funny thing is, he certainly didn't say that while his stock was at 64 at the peak in 1999. I mean, could you imagine it had he said that? But certainly looking back, he kind of put things in perspective. And again, and just to show you, with the price of sales at 40, at 4 times the level, and you look back again, early part from 2009 to 2016, really until 2017, you didn't even hit the 10 mark. So it was at a much better valuation. NVIDIA, it's a great company, right? They're really changing the way that we're looking at computing. But you still have to realize that when you invest capital in something, you need to get some cash flow back. That's the only way it makes sense. It doesn't matter how great a company is. It's how good of investment is it going to be. Now, Apple is, of course, another just phenomenal company, $3 trillion market cap. And it's been the behemoth from probably 2003 up until 2020. But it's not the same company because it's gotten to be a $3 trillion company. You're not looking at the same company that we were in the early 2000s when it was growing absolutely gangbusters. First with the iPod. I mean, it was absolutely revolutionary that you could have this little thing that was no bigger than a lighter that had 1,000, 10,000 songs on it. And then, of course, the iPhone came out in 2007. And that absolutely changed the world. I mean, just, think about it. 06, 07 wasn't that long ago, I guess. Maybe I'm getting older. but you didn't see everybody on their cell phones before '07. And then as soon as the iPhone came out, you started to see everybody on iPhones. I don't even think I got an iPhone, or I didn't even get a phone, a mobile phone, until like 2011 or something. I was probably the last man standing on that one. But anyway, so Apple is not the same company it was. Now, it's still a great company as far as generating cash flow, but you're not going to see the growth that they're expecting. The one chart I showed you with the compound annual growth rates, it was saying a 10% growth rate for Apple. I don't see it. Right now, you look at Apple's enterprise value relative to sales at the top there. And then the bottom chart is revenue growth. So the revenue's actually been going down. They're not seeing the kind of revenue growth that they once had. If you look at the bottom part of the chart from, 03 until probably 2012, I mean, that was just massive revenue growth, unbelievable revenue growth. So they're not seeing the revenue growth that they want. And this is after releasing the recent iPhone. What are we on, 15 now? And then also that thing that goes around their face, I don't even know what it's called, but, they've launched that thing. So they're seeing revenue go down year over year. And then their enterprise value to sales, it has hit a level that, it's just kind of peaked there. I mean, you can't look at that and just say it can continue to go up, especially when their enterprise value relative to sales in the early 2000s and mid 2000s wasn't nearly as high as it is today. And back then they had the revenue growth to kind of justify that kind of EV to sales ratio. They don't have that now. They're not the same company. They're still going to generate a massive amount of cash flow for an investor, but at these valuations, it's just not looking good. So this chart again is the same as I showed for NVIDIA. It's pretty busy, but the top is stock price. The middle chart is the trailing 12 months for earnings per share. And then you look at the price to earnings ratio. So again, what are you paying for those earnings per share? And you look from 09 up until really about 2020, you saw the price to earnings for Apple below 20, all of that period. So it wasn't really all that expensive. When you looked at the trailing 12 months earnings, it was kind of good. And they were still seeing some substantial growth there. But now since COVID, you look and you see what's been going with its price to earnings. So even just looking at Apple historically, it's selling for probably at least 1/3 over, or even in 1/2 of its traditional price to earnings ratio. So its price to earnings ratio is up 50%, but yet the revenues are not growing anymore year over year. And earnings per share has been going up. It has had a good boost, but a lot of that has been more of an internal kind of maneuvering and being, and that is important. But you're just not seeing, I don't know. I just look at the valuations on that. I'm like, this is not the same company. A $3 trillion company is not going to be growing like it was in the mid 2000s. It's just not going to happen unless they come up with something that's like the iPhone, that revolutionary, that thing that goes over your face. I don't think that's it. But unless they come up with something completely new that we don't see, maybe it'll be that sentient robot or something like that could change it, that comes out of nowhere. Who knows? But at this point, you're just really, you're really paying an awful lot to have a share of Apple. And I always throw in there, Warren Buffett being the greatest investor of all time, or at least being denoted that way. And he always talks about, you want to make sure you're buying companies at a reasonable price and that are delivering cash flow relative to the price you're paying. And right now, his company, Berkshire Hathaway, has over $157 billion in cash. It's never been even close to this level. So he is just sitting there in treasury bills getting, 5, 5.5, just sitting, waiting. And every time that Warren has done this, when he's built up a big cash reserve, it's pretty much because he thinks that the market is extremely overvalued and we're going to see some sort of downturn, that he's going to come in with this enormous cash load and just start buying companies. But he's been trimming the positions in stocks that he owns, and the percentage of stock ownership for Berkshire is at kind of an all-time low, and he's just sitting there waiting, and T-bill is getting 5.5% right now. So he just kind of says that he sees too much risk. Historically, right now, this is the price to earnings ratio I like the most. This is done by Robert Shiller, Nobel Prize winning economist. And what he does is he takes 10 years of earnings, and he does what he calls a CAPE ratio, a cyclically adjusted price to earnings. So rather than looking at just 1 year, like the trailing 12 months of earnings, or a lot of times Wall Street firms will try to project the next year earnings, he's saying, let's look at the last 10 years and just to get an idea of what it really looks like. And you can kind of see it's certainly not at the peak of what it was back in 2022 before that bear market hit. And it's not anywhere near where it was at the peak of the tech bubble where it hit 45. But still, even at today's level, if you look at that, we're rivaling what it was back in 1929. And again, this doesn't mean that we're going to have a market crash like 1929 or even 2000. But what valuations like this tell you is what can you expect as an investor in future returns. So the higher the CAPE ratio, the lower the subsequent returns are going to be for investors. And the thing, I've been talking about is a lot of this is driven strictly by the technology, specifically the Mag 7. There are sectors in the S&P 500 that are actually pretty well valued and can provide a great return going forward. This was just another chart that I saw that was pretty interesting, just showing that, right now, how many insiders are selling. And, it kind of looks, let me see if I can get the exact number. Well, right now you've got 145 sellers for every person that's buying. Now you're always going to probably have more sales than purchases. I mean, a lot of these guys and girls that manage these companies that are the, corporate executives, they get stock options. So as the stock goes up or as they get more options, it's an enormous part of their net worth. So they've got financial planners telling me, look, you got to sell some of this. You're way too heavily invested in your company. So you're always going to have more sales than purchases for the most part. Although there are periods there you can see that there were more purchases than there were sales, which is very bullish. But right now the ratio is just off the charts high. So insiders are dumping like crazy. And I'm wondering, this doesn't get into what companies are dumping, but I would bet you that people within some of these Mag 7 companies are dumping. In fact, the CEO of NVIDIA has dropped over $30 million, gotten out of NVIDIA stock. As I said, there is still some cheap valuations out there. And one area, and I've talked about this, is international stocks are cheap relative to the US. And you look at this chart going back to the 1950, and it gives you a ratio of the US divided by the global equities. So outside of the US. And there were periods where, international is going to outperform the US and vice versa. So if you look at, say, 1990, we had a period there where international stocks were way overvalued relative to the US. And that was due to Japan. Japan stock market got to be such a bubble. that at that point, if you had sold international and went over to US, you were very well rewarded. But then 10 years later, when the internet bubble peaked, you got the point where, relative to international, US was very expensive. And go back even more to the period of Nifty 50 in the late 60s, you could see relative to the rest of the world, the US was very expensive. Well, right now, I mean, it's at a 70-year high here, and not by a small amount either. So relative to the U.S. market, international markets are very, very attractive. And the big part of that is because the rest of the world doesn't have quite the dynamic technology sector that we've got. They're not doing all the same things that we did, as far as the technology companies. So they're not as innovative there. So it could be part of that. But if you're, again, buying earnings, you want to buy cash flow, it's a very good place to be. The other thing to look at, even within the United States, is a growth to value ratio. So growth stocks are going to be technology stocks. These are companies that are growing at a rapid pace, typically exhibit higher price to earnings ratio. The metrics aren't quite as good. Value stocks are more boring. They're very good cash flow generators, usually exhibited by higher dividends. Value is also companies that have been beaten up as well. So they tend to fall into a value. So if a company drops quite a bit, it becomes a good value. And you can see here the ratio of growth to value. While it's certainly not at the peak it was in 1999 and 2000, it is awfully high relative to history. And this chart goes back to 60s. Yeah. No, I'm sorry, 80s. So relative to the 80s, you basically are not quite at the all-time peak, but showing you that there is a lot of compelling reasons to invest in value stocks relative to growth. Because the other thing is, typically this reverses. This ratio, you can see when it gets too high, it does tend to mean revert. The other thing, if you look at history, if you look at the works of two Nobel Prize-winning economists, Fama and French, these guys are out of the University of Chicago, and they actually started some funds called Dimensional Fund Advisors. So they have found that over time, value outperforms growth. So it doesn't do it in any kind of short-term period, but over the longer term, if you want to deliver a higher return, you want to allocate more to value stocks than growth. And it looks like right now, it's a great time to be a value investor. So a few holdings I'm kind of adding in slowly. I'm not doing a lot right now because I think we're definitely due for some sort of pullback, probably around the world in all equities. It's just kind of crazy what's been going on in the Mag 7. So if the Magnificent Seven starts to see any kind of pullback at all, it's probably going to affect the rest of the stock market too. But the one I like, and we owned it for a part of the year last year, and I'm adding back into that, is the Franklin International Dividend Core ETF. This thing only cost 9 basis points, 0.09% per year. So it's a really low cost. And you can kind of see it's going to be obviously international, anything outside the United States. It's got a low price to earnings. So it's below 13 on price to earnings. And dividend yields close to 4% on this thing. So it's not a true value holding, but it does tilt that way because of its focus on dividend growth. And again, dividend companies are typically value companies relative to growth. So we'll be adding some of those. Another one I've been researching on the US side, like what can we get that isn't going to be loaded up with the Magnificent Seven? And this is one I'm adding in. It's the First Trust Rising Dividend Achievers. So you can kind of see this thing has a price to earnings less than 12. Price to book of 2, price to cash flow 9, and price to sales of only 1.83. Remember, NVIDIA was at 40. And what this thing kind of focuses in on is they want larger companies. So, they only invest in 50 companies, but they start with the largest 1,000 companies. But then what they're looking at is growth in the dividend. So they pay, dividend in the trailing 12-month period that's greater than the dividend paid the period for 3 years and 5 years before that. They must have positive earnings per share. And the earnings per share must be going up. They have to have a cash to debt ratio greater than 50%, so they can't be over indebted. And then they want to make sure that the payout ratio of the dividends is not more than 65% of the total cash flow. So they want a company that's still reinvesting in the future. So that, looking at these things, you're getting the dividend's not amazing. It's at, I think, 1.93% right now, but the U.S. stock market just doesn't have as much in dividends. But it's companies that are growing their dividends. It's companies that are growing their cash flows, and they're still investing in their company, in their future, and you're doing it at very compelling valuations. Another one that I'm slowly adding in, this is more of a mid-sized company, so this isn't focused. It does have some large company stock, but it's more mid-sized. And this is the Cambria shareholder yield. So the theory behind this, Meb Faber is the portfolio manager, and he's written a lot about it. You're looking at companies that are giving their cash flow back to investors. They can do that through dividends, clearly. But they also can do it by repurchasing shares. That helps you as an investor, as well as paying down debt. So they're taking an accelerated debt repayment purchase, which also, again, will help you over time as a shareholder. And you can see the companies that are really focused on driving the cash flow back to you, the price to earnings is way below what you're looking for in a typical mid-cap value or the S&P 500. So, price to earnings of 8, price to book less than 2. I mean, the price of sales there is less than 1. So, this is a very heavy value oriented holding, but yet, what he's not focused, it's not like, let's just get great value. It's let's find companies that are paying back their investors through either dividends, share buybacks, or debt repayment. So it does have some dividend yield, but it's not strictly focused on that. In fact, most of the companies are really more tilted towards paying down their debt or buying back shares. Okay, so basically what I'm doing is I'm focused a lot more on value. Now, I don't know if value is going to do all that well here going forward. I mean, there's so much just momentum in those 7 stocks. Like, retail money is throwing tons and tons of money in those 7 stocks. So could the bubble go on longer? It absolutely could. And value would probably get even cheaper than it is now. But at some point, you're going to be rewarded as an investor for buying companies on the cheap. You always are. One other quick little thing. I did get a question this week. The jobs number came out, and it was really smashingly good. It was, I think they were expecting like 153,000 new jobs, and they got over 300,000. So the market, oddly enough, didn't like that. So the market pulled back. Bonds struggled because with numbers like that, they assume that the Federal Reserve is going to stay on the sidelines and keep rates elevated. So it's funny, you get good economic news and the markets, they kind of tank with it. Anyway, so the question was like, all right, well, does this kill the recession thesis you've got? And is this a great sign? And I mean, it could be, absolutely, if these numbers continue like that. But I'm going to go back to what I've been saying all along is, first off, we've talked about this. If you look, this is through since February 2023. So it's basically almost a year. It's 11 months. So it's maybe not the best data. I'd like to get all the way through next month, but we'll know more then. but the vast majority of any of the job gains for the past year have been part-time workers. So you're seeing a decline of full-time work and increase in part-time. Now, that could be a bad sign, meaning that companies, they really would want to lay people off. But what they went through during COVID, when it was so hard to get employees, that they're not letting people go, they're just keeping them on part-time. But that's bad if you're an employee and you kind of get downshifted to a part-time job. Now you really have to probably get 2 part-time jobs. So it's not a good sign there. Or it could be on the flip side that a lot of people, maybe it's more part-time jobs because it's retirees, people who are 60 or older, or just kind of downshifting to part-time work. Or it could also be the gig economy that they talk about, where people just sort of, they're 1099 employees and they're working part-time. They work on their own schedule. You don't know completely, but if you look at this chart, if you're an employee, wouldn't you rather have a full-time job than a part-time job for the most part? So I don't see it on a whole as a positive, and it's a trend that continues to go up. The other thing we talked about previously when I talk about jobs is the federal government actually has 2 different ways to calculate the employment numbers. Now, the one that gets all the headlines is the one that came out just this week. It's the establishment survey, the employment survey. So it's basically the government trying to look at all the payrolls that are out there and determining data from that. But the other thing is the household survey. So the household survey it literally is calling households to see, are you employed? And if you are, then all right, you've got job. And if you're not, you don't have a job. If you have 3 jobs, you're employed, but they don't count it as 3 jobs. It's just, all right, this household is employed. Now, when you look at this, the payroll survey or the establishment survey, and then the household survey has an enormous difference between these two by about 9 million jobs. So the household survey is actually showing some declines in payrolls in new jobs. So what could be going on here, and again, I don't know exactly, but you just have to look at the data and try to make some conclusions. So the fact that the payrolls data or the establishment survey, it looks at total jobs. So go back to that household where they have 3 jobs. Well, the household survey says, all right, that's 1 employed worker, but the establishment survey says that's 3 new jobs. That's 3 jobs. So you could have somebody who went from full-time to 3 part-time jobs. In the household survey, there'd be no difference. You're employed with a full-time job, you're employed with 3 part-time jobs. But the establishment survey says, hey, we've just created 2 new jobs. That could be it. And I kind of think that might be it, because the other thing is the non-governmental, the best non-governmental payroll data comes from ADP. So ADP is a payroll company. I think they're the largest payroll company out there with Paychex right behind them. So they're looking at this data, and they're not influenced by government in any way. They're just kind of reporting what they're seeing. And the green is the establishment survey, whereas the red is ADP. And you kind of see a downtrend in employment from ADP, an actual payroll company, whereas you see the BLS is saying that jobs are becoming more and more plentiful. So I don't know. You don't want to say, oh, it's an election year, so they're going to fudge the numbers, but I don't know. It just doesn't make a lot of sense to me. And I think it kind of shocked a lot of people. But what the market's in like is it's probably going to be data that the Federal Reserve is going to use to not lower rates. And I don't have the chart in here, but the other thing that I've been talking about is that tax revenues are going down. So if you were seeing more and more jobs, it would make sense to think that you'd see more and more taxes coming from folks, but we're not. We're seeing tax revenues go down. Okay, so finish where I always finish off. That lawyers say, hello, here's a disclaimer. So if you're not a client, please do your own research. Okay. So that's basically what I've got for this week. I wanted to get a little, actually, it almost took an hour anyway. So I guess I didn't have time to do more to kind of get into, and maybe I'll do this next time, to get into, even if the Mag 7 are getting these higher growth rates, what's it really look like because of their current enormous evaluation? So maybe I'll do that. I'm also going to do an interview, another holding I am adding in slowly, and we'll talk about it next time. It's emerging markets. So emerging markets are international markets, but they're emerging countries. So you're talking about China, India, South America, Eastern Europe. And this one specifically is on India, and it's an ETF that is investing in kind of the companies that have gotten to the bubble-licious level that we're at now in the US. So it's focused as India has their consumer market starts to grow. People are going to use smartphones. People are going to shop online. People are going to do a lot of these things that they haven't done. So it's investing in the companies that are doing this in India. And, it's not just going to be Apple in India selling phones. There's actual companies in India that do that. So there's a lot of potential growth there that maybe they're at the stage of, say, 2004 that we were. So there could be years or decades of sizable growth for India. And we'll also talk about just India in general. It's an economy that is growing pretty rapidly right now, especially in emerging markets when you look at what's happening in China. So I interviewed the founder of this ETF firm, and he's going to talk a little bit about this ETF. So I'll probably put that in there. So let me jump over, see questions. Britain and UK are not exactly, that's true. Utilities are boring until lights go out. And how do you have five tech stocks without electricity? That's absolutely true. Yeah, utilities they're boring, but they're great value. They're boring. They just generate that cash flow. They do what they have to do. Good comments there. Yeah. So yeah, a good point here. A lot of the good economic news is lower rates of inflation, and that's absolutely true. So we still do have inflation, though. That's the problem. It's coming down, and I think the Fed's going to hang tight until they get an official kind of 2% inflation rate back to where they expect it to be. It's still about 3.5%. So we'll see if that happens or not. But the only way that they'll really start to cut a lot is if things start to go awry here in the economy or the banking sector. Okay. So yeah, that's what I've got for this week. And, I'm just not investing in holdings, ETFs, or individually into the Mag 7. I know it's kind of hard to sit and watch those companies do well if you're not in them, but the problem is it never ends well like that. Every time you get to bubbles like that, it just doesn't go well. If you had sat and watched 1999 happen in internet stocks and you just avoided them, you would have been far better off than if you went into them, even though that year and then early 2000 was great. Same with housing. Like if you bought a house in 2007, you struggled, if you kind of came in, but if you just waited, you've got to look at, is it a good value? So, okay. I think that's it. All right. Well, hey, everybody have a great weekend. And we'll see you back in a couple of weeks. And again, if you have any questions, please shoot them at me, because I'll use that in these presentations. So really do appreciate your questions. Take care, everybody.